Hello and welcome to Weekend Investing Daily Bytes. We're shooting episode 271 on 19th of August, and we're doing a Ask Weekend Investing round today after a while. This is round 28. So we've done 27 rounds of answering questions. More than 500 questions are there with answers in the question bank. All this is available on the Weekend Investing Hub, and this repository of questions can be a great source of learning for those who are coming into small case or weekend investing as new investors, and all their queries can get resolved there. But first, a look at the markets today. So after a long time, maybe after a couple of weeks, we saw the first red day on the market. Nifty coming off by 1.1%. Most sectors taking some profit booking. The leading sectors in profit booking were PSU banks, real estate, private banks, metals, autos, public sector enterprise. Almost all sectors were down between 1 and 2%. The only sector which was bucking the trend was IT, which remained flat because there was hardly any gains running into this day in the last 1 week, so there wasn't any profit taking as such. And some infra stocks and energy stocks also took some profits off the table. So nothing wrong in having a down day after several days of longs. We are still up 4.7% for the month. 8.7% for the month on Nifty. So that's a pretty healthy figure to have for net 1 month gains. Now we've just crossed that trend line on the Nifty from the top and closed there. So it's still very sort of iffy situation, and we've closed a weekly on there. So we are still not yet clear in terms of having crossed that resistance with a good margin and good volume. So depending upon how next week pans out, if we get a week next week, I think this may become a intermediate top for some time. And as I had been saying for some time, that some consolidation around these levels may be actually good for the markets going forward. So all in all, not such a bad situation. Of course, as profit taking came about, it encompassed all the segments of the market, whether it was small cap, mid cap, large caps, and all the segments were down 1 to 1.2%. Nifty, weekend investing small cases were also down between 0.75% to 1.9%. The excesses are always there on the other side. So market goes up, probability of strategies performing better than the market is high. Market comes down, and at least in the first stages of the fall, strategies give up more ground and then they stabilize. The heat map for the day is all red practically. Reliance down 2%, Levers down 2%, Maruti down 2%, ITC down 1%, Tata Motors down 3%. Banking all down. State Bank leading minus 2.25%. Bajaj Twins also down 2 and 3%. The only sort of green spots for some Adani stocks on the news of them getting the go ahead for giving open offer on Gujarat Ambuja and ACC. L&T also was up, but pretty much beyond that there was no green seen on the Nifty charts. In terms of the top gainers of the day, Wockhardt was a 12% gainer, Vardhman Textiles up 7%, Adani Green up 5%, Brightcom and Dhani Services also up 5% each. In terms of top losers, after several sessions of gains, I think coming almost 60-70% in the recent month or so, Zomato finally gave up 8%. Inox Leisure was down 6%. PVR down 6%. Borosil Renew down 6%. And MRPL also down 5.5%. Inox Leisure and PVR getting hit due to these film boycotts and low occupancy in the recent movie releases. So as I mentioned, 549 questions have been answered till date, most of them unique. So if you have queries about functioning of the small case platform, rationale behind momentum investing, or nuances about various strategies in weekend investing, or any question pertaining to our services, you most likely you'll find all the answers here, but we definitely keep adding more questions to this bank. So please go to the Weekend Investing Hub and you'll find these 27 episodes. The link for the Ask Weekend Investing rounds is also placed in the description in the video description below. So let's start with our questions for the day. So 550 is the number of question. I have 3 small cases from the expiry trader: all time high, all cap and NNF10. Is this a good and sufficient product combination for equity portfolio? So all 3 are very good strategies. NNF10 is focusing on the top 51st to 100th market cap segment. All cap and ATH are obviously all cap strategies. I would think that if you can add a small cap focused strategy to this, maybe an MI25 or an MI35 or a mid and small cap MI50, that can add a very good sort of small cap flavor to your current bouquet. But other than that, I think the combination is fine. If you don't want a small cap sort of flavor, you can stay with this. Next question is from Mr. Hussain, awaiting details of MI top 10. So details will be released very soon. I'm hoping less than a few days. So please do wait for that, and I think all your questions about MI top 10 will get satisfied. Next one is from Financial Guruji. Do you know any financial advisor who supports weekend investing small cases and who can help in deciding when to do SIPs, which strategies to choose based on risk profiling? So I am not aware of any financial advisor specifically who may want to, or who does a specific suggestion or advice regarding small case, but because we want to stay at an arm's length from the advisory model. We don't want any forced advice for anybody to come to small case or come to weekend investing, so that there is no there is no sort of ambiguity in terms of what we are doing and what somebody else is suggesting. So we want to keep this relationship at an arm's length. So I will not be able to suggest anybody because that may have some bias towards weekend investing. So please excuse me on that. Shravan has the next question. TATAELXSI was such a gem and only briefly part of ATH. With a short break we exited. Why was it never added again and held into ATH? So many Adani stocks never got into ATH. We are talking about in your DB, they have gained a long way. So Shravan, this is a totally non-discretionary way of picking stocks which has a lot of filters. So there are filters around volumes, there are filters around how far the stock may have extended before we get in. There may be filters about that has the stock run up too much in the last few days that we want to not catch the bus while it has already gone up 50% in the last 5 days, for instance. So there may be several such restrictions based on those filters, because of which some stocks did not enter. Or the other reason could have been that when that entry came, the particular strategy did not have an open slot for that stock to come in. So sometimes what happens is that 5 stocks get chosen, but there is no place for them to come in because nothing is going out, and that opportunity get missed. So we'll get lucky sometimes and we'll get unlucky sometimes. So take that into stride and not see this as a forced discretionary way of selecting stocks. That's all I can say on that regard. Next one is from Mr. Velu. I have two strategies, NNF10 and Evergreen, and I see both are almost the same in nature, except small stock universe. I want to continue with one in long term. Which one would you suggest? So I think NNF10 and Evergreen are very different. Evergreen looks at top 200 stocks, whereas NNF10 looks at 51st to 100th. It may so happen that currently the stocks that have been picked by Evergreen are also, many of them are in that 51st to 100th category also. Primarily some Adani stocks, I would imagine. But Evergreen has a very different flavor. It is also exposed to a hedge of gold at 25%. So from that perspective, I don't see them having much similarity. Between the two, I think if you are more risk averse, then you should go with Evergreen. But if you have some, choice of taking some larger risk than Evergreen, then NNF10 can be a good one. So NNF10 is more concentrated, so it will probably give you higher returns, but also higher risk in terms of volatility. Mr. Subramaniam has the next question. Request give for all small cases CAGR only post fees, transaction cost, consider Zerodha and short-term capital gains, which is the correct returns. You may consider 10 lakhs as investment. Present reported CAGR is misleading in my opinion. Sir, that is your opinion. I respect your opinion, but I do not agree with you. The current CAGR is based on the open, high, low, close average of the next day of transaction. So it is a transactional CAGR. Cost of each person is very different depending upon your broker, depending upon your investment size, depending upon your tax implication. There are people who pay full business tax because they're running an entire book on that. So this, while you may feel that this is misleading, in my view, it is not. Next one is from Mr. Pandey. Small case has not provided consolidated XIRR at portfolio level. Though through you, I want to request them to provide consolidated XIRR for different small cases. Fine, Mr. Pandey, we will again request them for the same. We have forwarded this request, I think from you only earlier as well. And they have promised that at some point in their roadmap, they will definitely include it. But they have a 100-point agenda right now, what all to cover in the next many quarters. But definitely, I mean, we do forward all the requests that come from our users to them. Next one is from Mr. MK. NNF10, you mentioned that it redistributes gains across so that each stock holding in the portfolio is capped at 10%. That is correct. However, when that stock moves out of the portfolio, do we also lose our gains with it due to its redistribution? So let's assume something came in at 10% at the beginning of the month, and then it went to 15%, and then maybe it lost momentum and it reduced to 12% by the end of the month, and maybe it got chucked out of the portfolio. So that 12% will get redistributed. So, if out of 100 you had 12 in that particular portfolio, then when you sell it, the entire portfolio, the rest of it remaining same, would have become, 102, and that 102 will get then redistributed into 10 stocks. So I hope I'm able to get that message across. But assuming that a stock stays in the portfolio for a long period, like for instance, Adani transmission has been there for 700%. So at every month, whatever is the increase in the percentage, it gets redistributed and it comes back to 10%. Then it goes up to 14, again 4% gets redistributed, comes back to 10, so on and so forth. So on the downside, whenever stock comes from 10% to 6%, it may lose out and it may get out. So that much money we've lost from the overall portfolio. I hope this is clear. If in case it is not, please do write back to us. We'll try to make it more clear. Mr. Mukesh has the next one. Sir, on Monday mostly when we rebalance, somewhere around 9:30 to 10:30, then also new scripts momentum majorly goes down. If there is a phenomena that you have observed that after 10:30 it goes down, then please rebalance after 10:30. Whatever time you feel that stocks go down, I think it's best to rebalance at that time. So in my view, there is no such one phenomena. I mean, there is no like a Monday phenomena that this has to happen every Monday. It may happen that in the first few minutes, first half an hour, the stocks may pop up a little bit more. But that's why the average of the Monday open high low close is taken, so that even if you are rebalancing at 2 p.m., you should get a reasonable average of the day. So I don't think there is any golden trick that I can tell you that you should rebalance at that particular point. The next question is why technology sector is not getting a push whereas market is in a good uptrend. So this is a fundamentally driven question. I am not an expert in any way on fundamentals, but my rough sense is that technology stocks follow the global technology trends, and global technology trends in Nasdaq have been stagnating after the fall, and the recent results from IT stocks have been below expectations. So I think they are consolidating, and that's why you're not seeing that push happening despite INR losing ground. That should have given some sort of tailwind to IT stocks, but my sense is that they need that tailwind from Nasdaq to really perform well. But again, this is my just guess from my side. Next one is from Mr. Amrit. In how much time should we expect the percentage based fee model to be rolled out? Also, any new products coming up? So percentage based fee models we want to do, but they are extremely difficult in terms of managing it, in sense of that, like the current facility of having a e-mandate where we have to set up a mandate on each account, and then there is paperwork and there is back and forth every month regarding how much percentage was the average capital, and then to charge it on a monthly basis. It's an accounting nightmare actually to do this on a monthly basis. So for simplicity, we have kept it at flat fee so far. At some point of time, I'm hoping that some UPI based cleaner system of automated deduction will come around, which is easier from the accounting perspective also. At that point we can definitely think about it, but given that our average ticket size is quite small in small case, it is about 5 lakhs, 6 lakhs, versus a lot of other managers who deal with very large ticket accounts, 50 lakhs, 25 lakhs, so on and so forth. There a percentage based model really makes more sense. And in terms of the new product question, yes, so India Top 10 is our new product that is about to come out. It will be based on the Nifty 50 stocks, 10 stocks, monthly rebalanced, almost very much like NNF 10. And we hope that we'll be able to churn out alpha on Nifty more than a few percentage points in the long term, and that we believe is a good return from a Nifty based product. Next one is from Mr. Shekhar. What should be the ideal weightage between core strategy and satellite? Can you share more on NNF on N10 and comparison with NNF 10? So again, the first part of the question is a financial planning question which I am not authorized or trained to answer. The question deals with how much risk you should be taking in terms of satellite versus lesser risk in terms of core. My own sense for my own portfolio would be to sort of do an equal weight, but that may or may not be applicable to you based on your goals and risk assessment which your advisor will have to give you. In terms of comparison of India top 10, I'm assuming N10 is that's what you are referring to, and with NNF 10. So they are very similar, very similar structure, both monthly rebalanced, both goes equal weight every month, both are having a target underlying at 50 stocks each. So from that perspective, the framework is very identical to NNF 10. The actual model is not identical, it's a bit different, but I would say it is very much in the vicinity of where NNF 10 lies, because NNF 10 has been one of our most popular and well accepted products so far, besides a couple of others. So that is the reason for designing the Nifty product also somewhat similar to NNF 10, because the acceptability and the sort of large number of users have vetted that format of 10 stock portfolio and the additional alpha that we have been able to generate there. Next question is from Mr. Sai Srinivas. I can afford to do SIP 5,000 only. Can you suggest some products? So SIP is not an issue if you go for products like, I think in MI20 you should be able to do a SIP. A SIP is largely dependent upon the largest stock in the portfolio at that time. So 2 times the largest stock should be your minimum SIP. So there can be times where the largest stock itself is 5,000 rupees. So in those cases SIP will not work. So my sense is that plan for at least 10-20,000 rupees of SIP. You may not do it monthly, you can accumulate it and do it quarterly, for instance. So in that case you will be able to do that transaction. Next one is from Mr. Shriram. Why aren't you talking more about your stairs? It would be nice if you could do more DBs on it so that we can learn, understand and enroll in that far. Please share your views. So we do a monthly stairs review video now. It's a very different segment of the market. And the numbers on that particular product are extremely small in terms of the interest in the market towards our overall products. So hence our focus towards that product cannot be equal to what the other products are, but we do create a weekly report on it and we try to do a monthly review session on it. So please wait for the end of the month review session and we should be able to answer all your queries based on that. And in fact, let me take this opportunity to say that Stairs has been doing extremely well in the last couple of months. In the last 10 weeks, I think both expiry model and the always in trade model have hit new highs. The futures model and the options buy model have also recovered a lot of lost ground that had happened. But I think overall we have made a good comeback on that, and we are seeing again increased interest in that particular product. I'll definitely make sure that we do a detailed review video very soon on that. The next question is from Repakas Sarat Chandra. I'm sorry if I'm not taking your name right. I would like to know the overlap percentage for NF10 and Evergreen. The WI blog shows very similar returns. So is it okay to keep invested in both, or one would suffice? Can you touch upon weekend investment strategies that go well together? So we do periodically some daily bites where we show the combination ROMAD strategies. I'll definitely ask my team to do more of that in the coming sessions. And if you can drop us an email and we will respond back to you exactly about the overlap for the current two strategies that you mentioned. Mr. Robin Singh is asking the next question. Investing in MI20 with the first time premium only, is it right time to put one more SIP in that? So SIP should not be based on timing, in my view, you should continue SIP over a longer period. The ideal horizon for SIPs for me is at least 3 to 5 years. That kind of runway you should have to gradually keep bringing in your capital, because lump sum is very difficult to predict anything that, if you bring in a lump sum, what happens to that in the next 1, 2, 3 years. What we see that is that over any 3 to 5 year period, you may start at the highest point in the market, and the market may go through the most brutal corrections. By the time it is 3 to 5 years, you will have significant gains. At least that has been the experience so far, and I have also started a long-term SIP strategy, publicly disclosed results since last October, where I started from the very top of the market, just to prove this point that starting from any top is not really so detrimental to investing, and one must invest, start investing at any point wherever they wish to start. But if you only have 2 installments to do, then maybe it's more of like an opportunistic investment. It is not really a SIP. So maybe you can wait for some pullback from where we are, and then attempt to put that second installment in. But that's, your guess is as good as mine on that. Next question is from Mr. Aniket. Does a stock leave the portfolio only after it has lost momentum, or can it be replaced by another better performing stock? So the design of the strategies is such that only after it loses momentum by a certain degree, that the berth gets vacated and a new one comes in. So you are to that extent right, that at any point of time there may be stocks that are doing better than what's already in the portfolio. That's always possible. So, and we can design strategies where it will churn into better performing stocks also, but there will be a lot of churn in that, and that transaction cost will really eat into the results what we are getting, and I don't think you will get superior results if we keep churning like that. So you have to leave something to chance a little bit, maybe chance or luck, whatever you may call it. Sometimes we will catch some fantastic multibaggers, sometimes we will miss most of them. So that is part of the game. Dr. Singh has the next one. 2 things. First, you had told about the decreased fee model for people who have more one strategy or over long-term holders. Any comments? Second, can you please run any of your strategies on an index like Japanese market, which are sideways? So Dr. Singh, we are we have given all these suggestions to the Smallcase platform, and they have it in their roadmap, where we want to start a sort of a loyalty program, where beyond a certain, let's say you've subscribed to a certain service and it's been 2 years since you have been there. So from your 3rd year onwards, it will automatically start to reduce the fee for you. It's almost like an insurance model. The more you continue with your car insurance, you get that no claim bonus discount. So in the 3rd year it is higher, and 4th year it is higher. So we want to do something like that, but we need the technical infrastructure to be built by Smallcase for that, because we can't manually manage thousands of accounts on this and do the different fee structure. It has to be an automated system. So we have been able to convince Smallcase to do this, and they have it in the roadmap. So my sense is that sometime this year it should happen, that we are able to come out with some benefits for longer term holders. Second question on Japanese market. So I haven't run it on Japanese markets, but my sense is that in any market there are always gainers and losers. And Japanese market, please also remember, that went up 4 times on the index before it crashed down. So if you had put the strategy in place in 1988, it would have minted like 10x in the next 2 years, and then maybe would have lost 30-40% on the way down, and either would have been sitting in low risk stocks, or maybe sitting in cash, so on and so forth. But I don't have the stock data, granular stock data for the Japanese market to run my strategy on for 30 years back data. I have run the strategy on American markets also, and it does perform very well on that. So momentum strategies, especially the ones which go and sit in cash. Like we've been through 2020 crash, we've been through 2008 crash in our back tests, we've been through crash in 2004, we've been through a crash in 2015, 17, 18 also. So several times the strategies have been tested and tested and tested, and I don't see any reason why it would not work in any other market. But yes, for the Japanese market, I don't have the data to test that. Oh, so we are at the end of this weekend investing round 28. Thank you so much for watching. Please do go over the past weekend investing rounds. If I have not been able to take your queries today, I may have missed some. I apologize for that. Please do send us a mail and we'll try to answer all your queries. Our purpose for doing all these videos, and I think no other manager does this, at least in my knowledge, is that we don't want anybody to have any questions unanswered. We want to answer all questions to the best of our ability, at least. And that is the whole idea of having these daily bites as well as weekend investing rounds, that whatever we can share with you, we definitely want to share with you as much as possible, so that you can take better informed decisions, whether to continue with weekend investing, whether to add more strategies, whether to add more capital, whether to get out of weekend investing. Whatever may be your choice of things to do, you should be a more aware customer. That's the whole bottom line. So thank you so much for watching, and I'll see you in another video. Bye.